Hey guys, welcome back to the channel. We're going to be talking about how to legally avoid crypto taxes. I know that many of you are holding profits within your crypto portfolio. I'm certainly getting more questions, and I have been trying for the last 2 months to find an accountant that can come onto a live Q&A to answer these questions, but there doesn't seem to be a lot of professional help within this arena right now because crypto is so new. With that being said though, I'm going to give you 3 legal ways in which you can avoid crypto taxes, plus some bonuses if you stick to the end of the video. To be honest, I thought you were there maybe a couple of months ago. The problem has been provider selection. There is actually a product there right now that you could wrap your crypto into that would be tax-free if providers had the ability to do that. So we'll talk about that towards the end of the video, but let's get going. All right, so I have done a video previously where I talked about taxes on crypto. If you want the basics, the foundation, I definitely recommend you go and watch that video. This is the thumbnail right here, but I'll also link a card up above as well. So for this conversation, let's start off by understanding what taxes are due on crypto. Well, there are 2 mainly. There's income tax, there's capital gains tax. We do have taxes like inheritance tax as well, which will be due, which is if you accumulate quite a lot of cryptocurrency as part of your estate, then inheritance tax is going to be due. We'll talk a little bit about that towards the end of the video actually, but the main 2 ones of concern for most people right now are income tax and capital gains tax. Now, depending on what you're doing in the crypto space and how you're interacting with crypto will determine which of these taxes you're going to pay. I would have to guess that most people will be in a position where they're going to be paying both income tax and capital gains tax on their crypto holdings. So let's start with income tax first. So income tax is going to be applicable if you are receiving airdrops. If you're receiving airdrops, capital gains tax is also applicable. We'll talk about that in a moment. If you're mining, then you potentially have a liability under income tax. If you're staking, income tax. And if you're being paid in cryptocurrency as well, then you need to be mindful of income tax as well. For everything else, you're going to be looking at capital gains. Now, if you are buying and holding, or if you're trading cryptocurrencies, coins, tokens, then capital gains tax is probably one of your biggest worries right now. We're going to address both of them. So how to legally avoid paying taxes on crypto? Well, the first thing is to have a look at potentially trying to offset your losses. That's right. So if you have been making losses on any crypto trades or purchases or investments over the last 4 years, you could potentially offset that against any potential capital gains tax bill that you're going to have. How this works is you can go back 4 years. It's called allowable losses. So for many of you, if you are buying coins and you've bought and you've sold, you're going to have to do a little bit of homework. Hopefully the platform that you're using, so if you're using eToro, for example, or Coinbase, you should have a track record of all of your transactions. What you want to do is you want to go back over all of them. You want to find out if you've made any losses and you want to document that loss amount as well. You can go back 4 years, and essentially what you do is you will add up that entire amount and you can use that to offset your capital gains tax. Now, on capital gains, the allowance is $12,300. So let's just try and put this into numerical context, right? So let's just say you've bought Bitcoin and you have made a gain this tax year of, I don't know, say £15,000, okay? So with £15,000, your capital gains allowance is $12,300. So the difference is now taxable. Now, let's just say, for example, that in the previous 4 years through your trades and your purchases and your investments, you've actually lost, say, £500 over that period of time, that you can offset that £500 from the difference of the £15,000 you've got currently and your £12,300 capital gains allowance. You take that £500 off and it will leave you with a lower amount for you to pay capital gains tax on. That capital gains is taxed at 10 or 20% depending on what your personal tax bracket is. So whether that's you're a basic rate taxpayer or a high rate taxpayer or additional rate taxpayer. So allowable losses are there. You can offset your losses, but you are going to have to do a little bit of work and essentially keep track of all your transactions. So the second way to legally avoid crypto taxes is by using something called allowable expenses. So if you are trading, if you are investing, and there are certain expenses attached to you trading and investing, you can actually offset the cost of those against your capital gains allowance as well. This is a link to the HMRC website where they actually outline how this actually works and what they mean by this. So I'm just going to screenshot this for you to actually read right here. I'm going to pop it on the screen. And basically, this is just an idea of what is actually allowed. So transactions fees paid for having the transaction included on a distributed ledger, advertising for a purchaser or a vendor, professional cost to draw up a contract for the acquisition or disposal of tokens, cost of making a valuation or appointment to be able to calculate capital gains or losses. So the last one is probably going to be more applicable to most people who are watching this video. So in other words, if you maybe have employed an accountant, for example, then potentially you could be able to assign that as a fee, as an apportionment to you understanding whether you have a capital gains or loss. So you could use that to reduce. Now, it is worthwhile noting that some exchange fees are also allowed within this as well. So if you are using Coinbase or Binance or Kraken or whoever it is that you're using to purchase or trade your cryptocurrencies, then some exchange fees are actually allowed within this as well. I'm going to leave a link to this specific page down in the comments. There are quite a few things that are allowed and quite a few things that are not allowed. It's quite lengthy, in fact. So I'm not going to go through everything here. And it also gives you some scenarios in terms of even if you are swapping, for example, tokens, some of that can also be allowed as an allowable expense as well. But go and check out the link, but that is one way that you can actually do. Now on mining is a bit of a weird one because you would think that the cost of you acquiring mining equipment or the cost of mining activities will be an allowable expense. Actually, it's not. Again, I will link down below so you can get a bit more context on this. There are certain things that are allowed and certain things that are not allowed. But essentially, when it comes to your allowable expenses, if you're employing an accountant to help you, or if you have exchange fees, then some of those will be included. Again, it's just about keeping track of what those fees are and making note of it and seeing if you can actually use that as an amount to reduce your capital gains bill potentially at the end of the year. So the third way for you to legally avoid crypto taxes only works if you're actually married, and this is a benefit of being married. As a married couple, you have a household capital gain allowance, which is ×2 of your individual capital gains allowance. So again, capital gains allowance is 12,300 if you are married. There are 2 of you in the household, so actually that's actually doubled to 24,600. So from a numerical context, what it essentially means is that you've made a capital gains of £50,000, for example, in opposed to you just using one capital gains allowance to reduce it by 12,300, you can actually double that to £24,600, which means that you're paying less on your capital gains and certainly less in terms of the tax burden for that as well. Again, it's not going to work for everyone. You have to be married for that. It is a benefit of being married, but it is a very, very good way for you to lower your capital gains tax liability as well. Now, I did mention that I did have a couple of other bonuses for you, and maybe these are just a couple of tips really. Look, because you're buying crypto and if you are trading on crypto consistently, essentially you have to think about what a disposal is. So on a screenshot right here, I'm just going to leave a definition of what a disposal essentially is. So a disposal is when you're selling a cryptocurrency for money, is exchanging cryptocurrencies for another type of crypto assets or cryptocurrency. So if you're going from Bitcoin to Ethereum, that is a disposal. Using cryptocurrencies to pay for goods and services is also a disposal, and giving away assets to another person is also a disposal unless you're doing it to a spouse. So if you're constantly trading your cryptocurrencies or swapping them for something else, that is a disposal. You're going to be liable for tax if you are above your capital gains allowance. So I guess the obvious tip here is buy and hold. And that comes back to doing really thorough research in terms of the coins that you want to hold and not kind of just following what people are saying down the pub, buying coins thinking, I don't like it, you want to swap out. you're going to be stacking up a lot of work for yourself, because remember, it is your responsibility to keep track of what you're buying and selling for tax purposes. It is nobody else's responsibility. You've got to do it. So thinking about disposals and the fact that, if you're trading consistently, you've got to keep track of it. The best thing to do is actually to buy and hold those cryptos for the long term. I did mention inheritance tax a little bit earlier on. So if you have got a massive cryptocurrency portfolio and perhaps you want to be able to leave that to loved ones, this may not necessarily work for younger people. It may work for older people who've generated quite a bit, but there is a way that you can actually reduce your inheritance tax liability. Now, inheritance tax is around about 40% on any assets over and above the nil rate band. As a married couple, your nil rate band, including your residential nil rate band, is £1 million. So essentially, you can transfer £1 million to beneficiaries and loved ones after you die without them paying tax. If you're a single person, well, including your residential, so your property, is actually £500,000. If you don't have a property, then you're looking at £325,000 as your limit. If you've got cryptocurrencies that take you over that, you want to leave it to your brother, your sister, your mum, your dad, your niece, your nephew, well, potentially they have a tax bill of 40% to pay before they can actually take ownership of what you want to leave them. So a method that people use to reduce their inheritance tax liability is leaving some money to charity. If you leave over 10% of your estate to a charity, then your inheritance tax rate actually gets cut from 40% to 36%. Again, this is just a bonus one, may not be applicable to everyone, but maybe something that's worthwhile knowing. So the last one that I want to leave you with is one that I'm actually really gutted about, because I thought this is a game changer. The problem here is provider selection. We actually have a product that you could use to keep all of your crypto gains completely tax-free, wrapped within an ISA. This isn't available just yet because the provider that has this ETF available doesn't have an ISA wrapper. Stake, please get your act together, because if you had this, it would be absolutely amazing. So a couple of months ago, we talked about Bitcoin ETFs, and I made a video about the ProShares Bitcoin ETF. Yes, it's a futures ETF. Yes, it is expensive. It's 0.98% as an expense ratio. I said, personally, I wouldn't use it unless I had a really good reason. If Stake or maybe Trading 212 or Free Trade had it available, because it is an ETF for you to purchase and put into an ISA, that would essentially mean that you could buy cryptocurrencies, you could buy Bitcoin and have exposure to the crypto space in an ETF that would be completely tax-free. At this point in time, though, the only provider that I've found who has the BITO ETF available, which is the futures ETF, which is the expensive one, is Stake, and they don't have an ISA wrapper right now. If they did, this would be perfect. Now, obviously, it's not a perfect solution because of the cost involved, but if I'm completely honest, if I had to pay 0.98% plus transaction fees and storage fees, probably taking me up to maybe 1.25 or maybe even 1.5%, I wouldn't mind it if I was able to keep 100% of my profits tax-free. Yes, there are issues with the fact that it is a futures ETF, so there are risks there, but it would make sense if it was available. Yes, still has its pros and cons, but it would be something that maybe I would actually consider and look at very, very seriously. But at the moment, Stake don't have an ISA wrapper. There are no ISAs currently that you can put cryptocurrencies into at this point in time, which is a real shame. I'm sure that this will move, and I'm sure that this will develop, and this will kind of change in the coming months and maybe through 2022. But I hope you enjoyed that. Hope you found it useful. Catch you later on.